Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matthew R. Meehan, alongside my partner, the Professor Luigi Rosabianco. What's on tap today, Lou?
Hey, Matt, I hope you're ready to eat a little humble pie, because this guest, he is bringing the fire. This gentleman is a JD, a CPA, a tax accountant, a investment advisor, etc., 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 and he's an overall really nice guy. So welcome to the podcast, Mr. Wayne Zell. Wayne, I got to tell you, we were talking a little bit in the green room, and I really want to start where we left off, because you taught us a very interesting notion. When you start the company, you need to start planning for the exit. Can you unpack that and explain to all these entrepreneurial wizards in the audience how to do that?
Well, there's a whole bunch of stuff that goes into it, but the main thing is you got to figure out what you want in the end at the beginning. It's, Stephen Covey writes about it. Everybody writes about it. I've written about it in my book. The idea of planning for the exit really starts at the beginning. So you have to understand when you want to exit. And if you're 25 years old and you're just becoming an entrepreneur and starting your business, you're going to say, 50, I'll be dead by 55, because that's the way 25-year-olds look at it. Or you may say, 10 more years, and I've heard that 100 times. 10 more years and I'll be out of this business and I'll do something else, whatever that is. Okay, can I hold you to it? And that's the first step, is when do you want to exit? How do you want to exit? Do you want to transfer it to family members? Do you want to transfer it to your management team? If you have a management team, do you even have a management team that you can transfer the business to? Or are you going to sell it to a third party? A lot of my clients are government contractors, I guess, unfortunately, in today's environment, but there are a lot of people that have built some very valuable businesses that service the federal government in a variety of different ways. And those businesses have attracted extraordinary multiples over the last several years. So they're thinking 3 to 5 years, I'll be able to exit. Well, I'm telling them it's probably 5 to 10 now, at least, if that. And so the idea is setting an outside date and then figuring what it is that you need to sustain yourself, your family, and your employees. Have you thought about your employees and how are they going to be incentivized to stay with you? So this is all part of the exit plan, but you start with how much do you need, when do you plan on exiting, and who are you going to exit to? And then, the next step, as a prior guest, I think, illuminated, very smart, get a valuation. Get it, even if it's an informal valuation of what your business is worth. Well, if you're just starting it, it's worth nothing. But if it's been around for 3, 4, 5 years, let's get a valuation, informal. It doesn't have to be a formal report, just to see what it's really worth in the marketplace today if you were to try to sell it. And that varies, depending on how the economy is doing, depending on what the government is doing or not, and so on and so forth. So all of these things are affecting your valuation. It may reset your expectations too once you get that valuation. And then you figure out, what's the business need to be worth to get me to where I want to be? And then what are my value gaps? How do I get there? How do I build the business to where I need it to be? And that is, identifying the value drivers in the business as well as the value gaps and how you fill it in. And the most important thing, I guess, for entrepreneurs that they just don't think about a lot is that you need to have transferable value in order to transfer the business. And what I mean by that, and I'm sure you all have had other guests explain that in the past, is if you're the founder and you're the chief and the cook and the bottle washer and you're doing everything for the business and you're the technology developer and you're the sales guy and you die, there's no transfer. On the other hand, if you've built a team below you or with you that can help carry on the business if something happens to you, then you do have transferable value. And that's where you can actually reap the benefits of what you're building. So to me, one of the most important value drivers is having a good, solid management team that will stay with you and will continue to build the business as you're growing it and allow you to transfer it without you being part of it later on. So I don't know if I answered your question. There
No,
was a
no,
lot of stuff
no, Wayne,
unpacked.
it's a wonderful start. So let's unpack that a little bit because it's naive of us to think that most entrepreneurs and founders are going to have that 20-year vision, right? Because there are market forces, there are economic cycles, there are macroeconomic conditions.
Yes,
Who knows? Walk us through some of the structural tools and tactics from day one that you can set in place so that that founder can focus on his business and not focus on governance.
great question. One of the things I do as a tax guy is sit down with the client at the front end, just when they're starting their business. And sometimes they come to me 3 or 4 years down the road, but when they're starting their business, the question is, what entity should you use? What's your choice of entity and why? So the first question I say is, well, what's your vision? What's your business plan for this business? I don't have one yet. Okay, well then let's keep it simple. Uh, Set up a limited liability company in Delaware or wherever in Wyoming and just go with that. But it becomes a question of, if you have a business plan and you know really how you intend on growing this business and how you're going to evolve over time, then the key questions are, what are you doing in the business? Are you a consultant? Are you building technology? Are you building a SaaS product, software as a service? Is there something that you're manufacturing that you can sell? All of these questions sort of filter in to help me design the choice of entity at the front end, because the choice of entity is going to influence the outcome at the tail end, particularly on the tax side. So we were talking earlier before we went on air about qualified small business stock. Well, that only applies to C corporations. And I think you all were surprised to learn that a limited liability company, LLC, can elect to be treated as a C corporation. That's true.
Yeah.
So you don't have to be incorporated to get the benefits of qualified small business stock. But these are all things that play into the design at the front end. If you're going to raise capital from a venture capital fund or a private equity fund or even angel investors, you're typically going to use a C corporation structure. And the reason is, you want to give the investors some kind of return on their investment. You promise them some type of preferred return, which only a C corporation can use, or partnership structure can use, but they're less used in venture funding. So C corporation, preferred stock and common stock. Whereas if your accountant tells you that you need to be an S corp, you've blown the ability to use any kind of preferred stock structure. So you can't differentiate between investors in an S corp. You can in a C corp. So it all depends on what your business plan is down the road. And I have a lot of clients that come to me and they say, well, I'm starting a fund. We're going to go out and invest in real estate. Okay, I've done a lot of real estate structuring. Let's talk about that. Who are you going to get investment from? Who's going to invest in your company? Are they individuals? Are they pension funds? Are they corporations? Are they venture funds, private equity? All of that's going to affect your structuring at the front end. If you're just doing consulting for yourself and for another business, keep it simple. There's no reason to get overly complicated. If you're going to hire employees, maybe an S corporation works, maybe it doesn't. So it all depends on, and if you're going to offer equity, ownership to the people that are working with you, that affects the structure at the front end. And so how do we do this? Myriad ways. I just try to dig into what the mindset of the person who's starting the business is at the front end. If they're just going to build a little retail store, keep it simple. There's no reason to get overly complicated with that.
Sure.
If they're going to do something complicated, then we need to think about alternative structures and how to do it, starting out and then allowing it to grow over time.
Now, Wayne, when confronting the realities of the market, how easy is it to pivot? So let's say I thought I was going to create a SaaS company, but you know
Yeah.
what? A year into it, that didn't really work out. I'm realizing the consulting portion of my business is taking off. Now, man, I got to call Wayne back and maybe I got to restructure it. How easy or difficult is it to do that?
Well, a lot of times they'll do both. And in fact, I had a guy that came to me about 2 years ago, and he's now launching his business. Hopefully, he'll be able to continue it. It's in the government sector, but He was doing consulting. He was making a great living. Then he needed help, so he started bringing on guys to work with him. But he was doing something cool in the software space, and he told me about this, and I said, you know what? Let's spin off the software development program into a separate company. If it works, great. If it doesn't, it's okay. You just have the cost of setting up the entity, which is not terribly expensive, and the ongoing maintenance costs, filing annual franchise taxes in Delaware or wherever you're setting it up, and filing annual reports, things like that. It's not terribly complex. It's not
nominal costs.
Yeah. It is. It in the grand scheme of things, it is nominal. But the idea is that if you get into a shift, he's still got the consulting practice separate. If you start out as a SaaS developer or a software developer, and then you want to switch off, you can easily set up a new entity that does the consulting work, which I have so many people coming to me that are leaving employment. There's 2.5 million government employees that are now out of work or will be out of work shortly, who are looking for alternatives. And will they be able to do government contracting? If not, what can they do in the commercial sector? All of these things are going to flood my gates, at least, with people that are looking for alternatives on what to do so that they can make a living. Because they're not going to just be able to walk in and get employed by somebody else unless they have a really highly specialized skill. So there's going to be a lot of business startups as a result of this change that's going on right now in the government. And so how do you do this? Well, if you're going to do consulting and you know that this is something that you can do, it's easy to set up, and we'll help you set it up, or you can set it up yourself. But if you're going to have partners, or you're going to start a new business, or you're going to do franchises, or you're going to start up a restaurant, God forbid, or do something that generates cash flow that can sustain yourself and your family. It all depends on what it is. So I think it's easy to pivot as long as you know how to do it and not get hung up on the structure that was set up originally.
So we mentioned QSBS. For those listening who don't know what it is, it's really amazing. And I've heard a lot of people actually talk about it, but never implement it. And Wayne, I know you've done that. Why don't we start by explaining to the audience what qualified small business stock is and how it could benefit them if they fit in that box?
Okay. In order to qualify as a qualified small business, you have to meet certain requirements. But why do this? That's the first question. Well, because if you qualify and you sell your stock and your consulting is not under the code section.
Is anyone left in America?
What's that?
Is anyone left in America with all those exclusions?
Yeah, there's plenty of people. Manufacturers, software developers, technology developers, restaurant owners. I mean, you name it. And I've got some restaurant chains that I represent. They would qualify if they were originally structured that way. So the idea is that you got to be a trader business. You can't have more than a certain amount of money invested in you at the front end in order to qualify. So it may knock out some of the higher end VC startup funds.
What is that number? That
50 million.
50 million?
Yeah.
Okay.
So the code section is 1202, and you can read about it just by Googling.
That knocks out Matt's lemonade stand.
What's that?
That knocks out Matt's lemonade stand.
No, Max Lemonade Stand would qualify.
No, but it was like the Taj Mahal. He put 55 million into it.
So yeah. So I mean, again, it gets very technical when you get into the specific requirements. You have to have held the stock for 5 years. That's another requirement. You have to have acquired it after September 13th, 2009, which is the date on which they expanded the exclusion from 75% all the way up to 100%. It's 100% exclusion though. And so it's amazing. And we've done it for multiple clients. I've got one client, he actually transferred his stock by gift into 3 non-grantor trusts. We helped him do that. And it created 4 taxpayers leveraging his ownership from the exclusion of 10 million all the way up to $40 million. And I've done it twice recently with other clients. But the idea is that when they go to sell the company, and they sell the stock of the company. And it's only the stock of the company that you can sell. You can't sell the assets, and you can't sell stock and have it treated as an asset sale, because that would destroy the ability to use Section 1202. And it's only C corporations. So again, the idea is to make sure that you're aware of all the requirements and don't run afoul of them from the beginning. Or a question that you guys were asking me before, what happens if you started out as a LLC taxed as a partnership or something like that? Can I convert? Well, you could convert, but you might trigger some tax consequences when you do that. And then the holding period starts upon conversion or sale of whatever it is that you're trying to qualify as qualified small business. So I had a guy, he was doing consulting, and he started developing software. And he said, should I do something with this? Should I keep it in this consulting business? I said, no, let's carve it off, sell it to a C Corp that you own in exchange for a promissory note that's not payable for many years into the future. And under the installment sale rules of taxation, there's no tax on the sale until you actually receive a payment on the note. And so you might even be accruing the interest on it too. So there's no payments coming back until the software starts generating revenue. Once it starts generating revenue, we might qualify for exemption from state income tax on the way it's structured, as well as 1202 treatment when it's time to sell the great idea that you're building in this separate entity. So there's lots of different ways of handling this. It's just you have to be cognizant of what the requirements are, and they're very strict, and the regulations are very specific about what you can and can't do.
So let's say I was a search fund, or let's say I'm trying to do business acquisitions myself, and I want to go find a company that qualifies for QSBS. Can I actually acquire another company, put it in there, and then have it qualify within a 3 to 5 year window if I held on to it for that long?
Yeah, you can acquire another business,
Hmm.
subject to the constraints on how much you pay for it,
Hmm.
and uh, and your structure as a
Hmm.
C corp.
Uh-huh.
You can qualify from that point of acquisition forward. And so
But
your
this
holding period starts on the acquisition date, not on the date that the
C
guy
corp was
started
filed.
his business or her business.
Well, it's on the acquisition date, or is it on the date I filed the C corp?
No, it's on the acquisition date,
On the acquisition date. Okay.
because you're acquiring another business. And the question is, did it qualify? So there are very specific rules about this. I don't want to overgeneralize.
Hmm.
There are rules about redemptions and
So
acquisition.
Does Matt inherit the cost basis of his acquiring company?
No, if he acquires the company, the assets of the company
Yep.
usually is what the way it would be done. He has a purchase price that equates to the value of what he's buying,
And
and
that's
his
his
tax
basic.
basis is now higher. But it also sets the limit of what you can. So if you paid over $50 million for it, no, it's not going to qualify for QSBS. If you paid $5 million or $2.5 million and you put it into your C corp, now you can start the holding period running. And
Perfect.
it is a 5-year holding period.
This is a huge benefit, though, when you're out there raising money too, if that was what you were looking to do, because who doesn't like, because every investor that invests and gets money from the C Corp would be
Yeah.
qualified underneath this, right? As long as it
Yes.
comes from the C
From
Corp
the
itself.
initial investment, right? But the issue that, again, you've got to make sure that it's not worth more than a certain amount when the investors come in. That's the
Mhm.
$50 million limitation. And you've got to make sure. So if you put together an investment partnership, the investment partnership is limited to its $10 million exclusion, and all the partners have a piece of that $10 million exclusion. They don't have separate $10 million exclusions. So again, there are very specific rules about how you can utilize the exclusion and how you can leverage it. But you could gift stock to somebody and they would get a $10 million exclusion on top. That's what I was alluding to earlier
Yeah,
in terms of $40 million
that's
expansion.
amazing.
It is.
But
It's pretty cool.
but this is something that's extremely important for people that want to sell their business, right? Maybe you set up the C Corp and you sell the company, or you do the installment agreement, and you kick it down the road 3 to 5
Yeah.
years, so you're not paying all this tax, right?
Yeah. The not three, it's five.
Okay.
Okay. There ain't no three. There ain't no four. There's no pro rata. It's 5 years. You don't hold it for 5 years, you have to pay full capital gains tax. But the idea is that if you hold it for that 5 years and it was established after September 13th of 2009, then you will qualify for this exclusion. And then thinking about that at the front end, which is where Luigi started, that that's where I would be asking that question at the front end. If they know, a lot
Mhm.
of times entrepreneurs, they have no idea. They're just starting out and they've got a great idea and they're going to start their business, and whatever they're going to do to make money, they're going to do it. But if they're going to build a product or a prototype or something that could be licensed or a technology or whatever, that that would, in my view, qualify for QSBS treatment. And so you want to structure it right.
No, that's amazing. QSBS is awesome, but again, you have to qualify and be a certain type of company in order to get that taxable benefit,
Yeah. The
right?
other thing about C corps that people forget about is that they can be merged into other publicly traded entities tax free, as long as you don't get too much cash in the deal. So some people are willing to exchange their stock for publicly traded stock. It might be subject to a lockup for some period of time, but you get the publicly traded stock, and as long as your counsel negotiated a good deal for you, you get out of the lockup really soon, and you can liquidate and monetize your investment quickly. So we've done a lot of tax-free mergers. We've done partial tax-free taxable mergers. And as you probably know, a lot of the private equity world, when they're acquiring companies, will want you to keep some kind of rollover equity in the structure. And so when you're dealing with C corps, it's a little harder to do that. With S corps, it's complicated, but it can be done so that you're not paying tax on rollover equity that you receive in the deal. You're only paying tax on the cash. And so we do a lot of restructurings for medical practices, health spa practices, chiropractors, dentists. There's a lot of people that are using roll-up strategies to acquire other practices so that they can not have to spend 100% cash on acquiring these other smaller businesses. They can use their equity as well as their cash to acquire it. So, how do you minimize the tax consequence to the seller? You got to know how to structure these things, and that's where I get involved a lot. So
No, I love it. And QSBS is just for, a certain small section of people, right? But
yeah.
how do we mitigate our tax upon sale if you're just an everyday business? What are some strategies that you like to use?
Well, again, if you're looking at selling it to a private equity firm and you're going to get 30% in equity and 70% in cash, which is not an uncommon structure, or 80-20 or whatever it is, you don't want to have to pay tax on that equity if you can avoid it. And so you may have to drop, if you're an S corp, you may have to drop your operations down into a subsidiary, and the rollover equity will be held by a new holding company that's an S corp. You convert the operating company into an LLC, which is then becomes a disregarded entity, and you sell the LLC interest, not the assets, because asset sales are hard to do. Sell the LLC interest, which is like a stock sale, but it's treated as an asset deal, and you only pay tax on the cash that you get. And if,
Okay.
as long as you keep that private equity locked up in that S corp, you don't have to pay tax on it. So that's one strategy known as an F reorganization structure that's used very commonly in private equity deals. Then, as I was describing a minute ago, you could enter into a tax-free transaction if you're an S corp or a C corp. It's got to be a corporate structure where you're swapping out your stock in exchange for stock of the acquirer. And if it meets certain tests, there are different structures that you can use: A, B, C, D reorgs, F reorgs, that will allow it to qualify for tax-free treatment. And if you meet the requirements, then the stock that you get back won't be taxed. The cash that you get, if you get any cash, if you're allowed to do it, will be taxable. But the stock that you get back won't be until you sell it. And so
Okay.
that helps you defer the stock. And then last but not least, one of my most favorite things to talk about, but we don't do a lot of them, is because they're really expensive to do, is an ESOP. So an
Okay.
ESOP is a real unique structure that allows you, if you're a C Corp, you can actually sell your stock to an employee stock ownership plan using bank leverage to help pay for your stock. You get to deduct the principal and the interest in the corporation. And when you receive the proceeds, as long as you invest them in publicly traded securities, there's no tax because there's a section 1042 of the Internal Revenue Code that allows you to roll over the gain on the sale of your stock to the ESOP into qualified publicly traded securities. And here's where the estate planning comes in. If you hold on to those securities until your death, you get a step up in basis. There's no tax that's ever imposed, at least under current law. Who knows where it's going to go in the future, but that's been around for 50 years, 60 years. So I wouldn't expect it to go, away anytime soon. ESOPs are great. They're a tax-oriented vehicle. It requires, a certain size company, generally over 5 million in revenue, and generating cash flow with a growing group of employees who want to participate. It's a qualified plan under the Employee Retirement Income Security Act, so it has to meet certain very rigid requirements: non-discrimination testing, annual filings, annual valuations have to be done. It means you have to go out and pay an appraiser every year. So the cost of setup and the cost of annual upkeep is very expensive with an ESOP, but sometimes it's worth it. This is a sad story. I have a client we were doing some advanced estate planning for last year. And at the end of the year, corporate counsel called me up and said, "Hey, can we unwind the gift transaction that you did?" I said, "Sure." "Why?" I said, "Because we're thinking of selling to an ESOP." I said, "Okay. If we sell to the ESOP, why does the earlier transaction matter?" "Well, because it might affect the way an ESOP trustee looks at the valuation of the company. It might be too low, and therefore she might not get enough on the sale of her company." So we unwound the transaction. Government came in and basically shut down one of the agencies that she does all of her work with. Business is worthless now. I don't think she's going to do an ESOP at this juncture. But it's sad because that's where a macroeconomic change can affect your planning dramatically. And what's your contingency plan for something like that? Nobody planned for what's happening right now in the federal government. No one did. And no one should. In fact, I won't go into politics, but it's illegal what they're doing. And so what do you do about that? Well, there are other contingency plans that everybody needs to have in the event of disability or death or an industry change. You've got to be able to pivot to something. And so what is your contingency plan? And that's one of the things I focus on a lot, is making sure that clients have thought about plan B and plan C down the road, just in case something happens.
Wayne, in your experience, when you deal with owners that are considering an ESOP, do ESOPs help nurture client retention and employee retention, employee morale, and just that goodwill within the company?
That's a great question. I think it's intended to do that because employees then have
A vested interest, maybe?
vested interest in the company going forward, and therefore they're incentivized to make the company more valuable, because therefore their wealth will be increased by the value that they're creating as part of the overall puzzle. So yeah, I think it does increase employee morale. I've dealt with ESOP companies that have been ESOP owned for many years, and then the question is there enough juice left in the employees to keep the company growing as an ESOP owned company for the very long term so that everybody gets the benefit of growth over time? And that's really a question that I can't uh, opine on. I think it really depends on the company. Every company is different. If the employees continue to perform and grow it, yeah, it'll be a great incentive. Oftentimes, and I've had this happen too, I had a company where it was a group of TV stations and radio stations, and I represented the founder. He had set up an ESOP. When it comes time to sell the company to a much bigger company, ESOPs tend to be an impediment. And that's one of the things you have to think about down the road, is if your ultimate goal is to sell the company from the ESOP to a third party, there are very serious constraints on what can be done. So we often have managers owning a piece of the company and the ESOP owning a piece of the company down the road. What can the managers do that the ESOP can't? Well, that's where the ESOP trustee has a fiduciary obligation to step in and make sure that everybody under the ESOP plan is getting the same benefits that the managers are getting. So you can't jack up compensation and do some things that you might do in a closely held corporate setting when you're involved with an ESOP. So it can be a great incentive to retain employees, but long term, it's really dependent on how the employees work as part of the ESOP and whether they can keep the company growing so that they can really get value out of the investment that they've made in deferring some of their salary or taking ESOP participation as part of their compensation.
So you've dealt with some pretty high dollar value transactions, right?
Yep.
So when you get to a certain dollar value, you're using investment bankers, right? There's lawyers on the other side. What are some negotiation tactics you've seen, either from private equity or attorneys on the other side? Some dirty little tricks that they always tend to play to maybe see how good you are on your side when you
Read
represent.
chapter 5 of my book.
I want to tell everybody about the book.
The book is called Your Multi-Million Dollar Exit. I published it last May, self-published it basically, but we won a bunch of book awards, and it basically infuses estate planning with the business planning stuff. And in chapter 5, it talks about all the things that sellers need to be aware of, because most of the time I'm representing the sell side. I'd
Mhm.
say 95% of the time. I'm a sell side lawyer, and I'll be involved in negotiating with the big law firms. Any number of names that you can throw out at me, I probably have done a deal with them where I've sold the company to a private equity firm or to a strategic buyer that's represented by a big law firm. And the keys, I think there are many different keys, but as the transaction grows in size, one of the recommendations I make is consider using representation and warranty insurance, which will cut down on the negotiation between the lawyers and the money spent on legal fees, which is, I think, an
Can
important.
you just take a step back and explain
Yeah,
exactly what that is for the
reps and
audience?
warranties
Do they
insurance.
understand? Yeah.
You hire an Aon or somebody like that that offers this insurance to cover any liability that arises on a breach of a promise that was made by the seller in the acquisition agreement. I promise that the financial statements were prepared in accordance with GAAP and are accurate and true and so on and so forth. I promise that I've made all my tax filings. I promise that there's no current litigation pending against my company. There's an insurance company that will come in and actually provide insurance for a premium, often split by the buyer and the seller, that will reduce the overall holdback that a buyer wants to protect themselves on for breaches of these promises that the seller's making when they sell the business. Because the more sophisticated buyers who are represented by bigger law firms are going to have 80, 90-page documents that have 45 pages of reps and warranties and 10 pages of indemnification language that you've got the seller who's never even heard of this stuff before has to begin promising to the buyer that all this stuff was done properly, that my corporate books and records are in good shape, that I own the stock that I say that I own, that there's nobody else out there that is claiming ownership, that I'm in good standing, all of these things that you have to make promise to the buyer. Your lawyer, the seller's lawyer, has to make sure that as much as possible that stuff is true, but there's only so much that the seller's lawyer may know. And so that it's the seller that has all this knowledge. Well, the reps and warranties insurance comes in for a premium. Again, it has to be paid up front.
And
Um,
who pays that? The buyer or the seller, or is it
Oftentimes it'll be
negotiable?
split. It's a
Okay.
negotiated point. It depends, again, if the buyer really wants the seller, they'll agree to split the premium, and then that reduces the escrow that has to be set aside, the holdback that has to be set aside to satisfy the buyer that they're protected from any claims that might arise after they close the deal.
Mhm.
And so that's a major part of negotiating these transactions. And so that's that is one thing that I often negotiate into the deal if the deal's large enough. It has to be, probably 30 million and up in order to justify reps and warranties insurance. And then, you know, oftentimes a buyer is going to say, "I think your business is worth X dollars." The seller thinks it's worth more. The buyer says, well, I'm not willing to pay you that extra amount. But if you hit certain targets, if you achieve certain revenue targets or profit targets over a period of time, I'll give you that extra amount. That's known as an earnout or a contingent purchase price. And I want my seller, as much as possible, to have control over that. So what people don't think about is, okay, you get acquired, now you are working for the buyer. If the buyer has the right to basically take your people and shift them to different parts of the business or to terminate them, you may never earn that earnout. So you want some protections from the buyer doing certain things during that period. If you agree to an earnout, I don't like them, but if you agree to them because you want to get that upside, you want some control over that. And so if they do something that violates what we put in the purchase agreement, you can accelerate the earnout and get paid up front. And I've had that in deals that are investment banker negotiated deals in the past. So it's not easy to get. And then the other key is, what do you put in these reps and warranties? All of these representations and warranties and covenants that only lawyers really understand what is going on there. Maybe the investment bankers have some understanding of it, but they don't get into all the details of negotiation. So the idea is you get a lawyer on the sell side who knows what should be and shouldn't be in these agreements and can push back on a buyer who's saying, I want you to promise me, that nothing has ever happened in the history of the company. No. That's not the way it works. So, and then what kind of baskets and liability limits and liability, floors can we put in these agreements that is consistent with what the marketplace is doing? And so the investment bankers know this stuff. Some business brokers do, and a good, sell side lawyer does. If your lawyer is a general practitioner, he's not or she's not going to know this stuff. And so you want to bring in somebody who's a little bit more experienced in doing these types of deals. And then if the deal is a big deal with a lot of employees and a lot of complexity, you do want to use a big law firm, which I'm affiliated with a bigger law firm. I'll bring them in to work on those more complicated deals where there are environmental issues, financial issues, and ERISA issues, and you name it. So,
Wayne, let's go back in time a little bit. I'd love to hear what your exit strategy was when you were 20 years old. Because I don't think you took on anything that was easy. You went to law school, you became a CPA, you became a financial advisor. I mean, you're not exactly. I'm in the mood for a snack. Let me make a grilled cheese. You're making that zabaglione, right? So walk me through what your plan was before you started tacking on all these initials at the end of your name.
I didn't have one. No way. In fact, at 20, I wouldn't even equate me with anyone who could be considered an entrepreneur. I was an idiot at that point in time. So as I got older, as I matured, as I got married, started having children, I realized that I needed to do something. And so my training was to provide a lot of this advice to others. And as I became more experienced, I mean, I've been doing this for over 40 years now. As I became more experienced, I learned how to do things the right way and made mistakes and watched other people make mistakes and learned from that so experience is really important. By the way, AI may replace a lot of things that lawyers do, but it won't replace experience. I hate to tell you, you need somebody who's been there and done that a little bit. So at 20 years old, no. At 27, I got out of law school, I was probably 27, 28, because I worked as a CPA first for a big 8 accounting firm, and then I got out. But I always knew that in order to succeed in what I was doing, I had to stick to my knitting. So tax was my underpinning for everything. Starting right out of undergraduate school at UVA, I went into the tax department at Arthur Anderson and Company in Washington, D.C., and I stayed with that all the way through law school. I focused on tax courses and corporate and estate planning courses. Got out, started doing these two areas of law: estate planning, corporate business, and have stuck to my knitting since the beginning. And I think if you stay close to your areas of expertise and you learn more and more and more about it, then you know what you like doing and what you don't like doing, and you direct your practice in that area. I know what my exit plan is. I'll be working for a little while longer. But at some point, I want to transition my business over to somebody else, and I've already started that process. And
Are
so,
there are there some young buck attorneys at your firm that will take over, or do you think it'll be an external third party?
I mean, you never can plan exclusively for that because they may not stay with me. They
Sure.
may decide, well, I want to retire myself, and they're younger, but not so young that they can't retire. Maybe their spouse is working. There's so many different issues in a small boutique firm. So the thing that I look at is it's probably going to be combining with a larger firm, which I did once before. I had Zell Law Part One, merged it into a firm that was about 50 lawyers and didn't like the way they practiced. There was no technology, there was no planning, there was no budget. I got out and restarted my law firm again because I use technology, I use budgeting, I use the entrepreneurial operating system by Gino Wickman. I look at practicing law as a business as my clients look at their business. So I'm an entrepreneur as well. And so I know that there will be an exit for me, and I have the timing set out, and I know what I want to get out of it, and I know what I want to get over the next, 4 to 10 years, depending on if I survive that time. So, it's just a question of survivability. And by the way, every entrepreneur who's listening to this needs to have a contingency plan so that who's going to manage the business, who's going to manage the managers. I call it a management succession plan. You can go to my website at waynezell.com, which is my author website, where there's a resource on there that shows you a management succession plan. And you've got to link it to your estate plan because a lot of people will do their business planning and they forget that they can't leave their wife or their husband in charge of the business if they don't know how to run a business. And even if they do, it may not be, oh, there you go, may not be a good idea to do that. And so you may want to have a board of directors or a board of managers set up so that you can properly run the business down the road. So, it's important to plan for the unexpected just as you're planning for the expected.
Wayne, thank you so much for being here. We don't want to take up too much of your time. Again, I know everybody can go to
It's a lot of fun.
waynezell.com. Where else can they find you? Can they find you on the socials anywhere? LinkedIn?
Oh yeah, all over LinkedIn, Zell Law as well as Wayne Zell. I'm on, I'm on Facebook, but I don't really like using Facebook. LinkedIn is number one for us, and then YouTube.com. We have a ton of videos, probably 100 and some videos, both interviews with entrepreneurs, but also most importantly, content. Our marketing is educational marketing, and it's all about providing good content to people who want to learn about estate planning, tax, and business planning, and business exit planning particularly. And get my book. The book is available on waynezell.com. It's available on Amazon in paperback, hardback. You can get the Audible version, which I narrated, and it's a lot of fun. It gets into a lot of detail, and we've gotten a lot of good feedback. In fact, I've gotten clients from people who bought it on Amazon. So it's a good resource, but I highly recommend that you use it as a resource to direct your thinking as an entrepreneur, because those are the people that I mostly work with and family-owned businesses, and it's just a lot of fun. Really enjoy it.
Wayne, again, thank you so much. One question before I let you run. Tell me the funniest negotiation story you ever came across.
Funniest negotiation?
Yeah.
I don't think of negotiations as funny. God, let me think about that. What is the funniest negotiation I've ever had?
Over the years, you had to have had a crazy client.
Oh, I've had all kinds of crazy clients. Crazy negotiations. Yeah. I've negotiated. I had a guy come to me. This must be about 15 years ago. And he had a government contracting business and it was declining. It was just going down the tubes. And he said, I want to sell it for $3 million. Okay, fine. So we go to visit this guy who's in the acquisition mode and he's very well known in the community, software development, technology, really good guy. We sit down with him and I'm just holding my tongue. And my guy, who's a sales guy, goes, I want to sell my business to you for $3 million. And the guy goes, well, show me your financials. You don't want to see my financials. You mean you want to see? I have to see your financials. If I'm going to offer you $3 million, is it really worth $3 million? He presents the financials to the guy, and the guy looks at it and he says, dude, your business, I wouldn't give you $100,000 for it right now because it's declining. And if something happens to you tomorrow, there's nothing left. Who's going to run this business? You have all the relationships with the contracts. If I try to get my guys in there on the contracts, they'll just terminate the contracts. So it's not funny. It's really, owner expectations are really wild. People, think their business is worth, 15, $20 million because my neighbor down the street who operates a similar business sold his for 15 or 20 million.
Yeah.
Well, just like the example I used of the woman who was thinking of selling her business to the ESOP, today the business is worthless. It's zero because they've shut down the agency that she was doing all the work with. That's the more scary stuff. I mean, so funny negotiations. Negotiations are serious. You want to be really serious about this stuff. You don't want to, have a kind of flippant attitude.
I was going to say we have a different sense of humor when I said funny and you threw that story out at me.
Yeah. It's like, it's not funny. It's like,
No, it's
scary.
It's really, people don't think about it, and it's eye opening. It's important, right? Everybody, we plan, but we make plans and God laughs, right? Look at what happened with your client. The current's always moving, the wind's always moving. You need to be able to have somebody on your side that can help you set the sail a little bit different so you don't crash.
You got it. Or if you're crashing, how do you adapt so that you can salvage what you've got and then build from that? Because again, we have no control over the macroeconomic factors that are affecting us in the marketplace, or people that are coming in and changing laws without having the right to do so. We have no control over that as individual citizens. Eventually that will come about, through court cases and other things. But for right now, all these people who work for the government are left without jobs. What are they going to do? This happened, by the way, back in 2001 when the tech bubble burst.
Mm-hmm.
Yeah, sure. And it happened again in 2008, in 2009. So, this is, I think, a little more serious in terms of the government itself, but you all are going to feel the pinch of it, not just the government employees. All of us are going to feel this. We're going to feel it in higher prices, et cetera. So how do we how do we adapt? And it's being adaptable and having a mindset of growth, not fixed, a growth mindset, so that we can adapt what we've got to do what we need to do. So if the government was providing benefits to people who needed it and they can't do so anymore because there's no money to fund it, who's going to step in and do that? Because somebody will. Charities, churches, religious organizations, eleemosynary philanthropic organizations will step in, and then they're going to need help in supporting these projects that might be supported by people who are in the mindset of supporting people who don't have, that need to be supported. So there's so many different ways of looking at this, but the key is be adaptable and be flexible and do it quickly. Don't, go, oh, woe is me. I had somebody come to me who was at USAID, and she said, I've been working with them for 25 years. She said, I don't know what to do. I'm grieving. I don't know what to do. I said, come down, sit down with me. Let's figure out a way of tacking your expertise in human resources and coaching into the commercial sector, because it's going to be needed wherever you are. And so let's figure out how to get you doing that. And so that's part of what I do too. So,
Wayne, thank you so much for being here. We really appreciate it. Everybody, that's a wrap. The Liquid Lunch Project. We'll catch you on the next.
Great. Thank you.
Thank you.